Welcome to part 2 of aggressive intraday trading. This is the Specialist Trading Weekly E-mini lesson for the first day of July 1st, 2011. Now I'm going to go a little bit deeper into this aggressive trading lesson today. We're going to show you where to place your stops. But before we begin, as always, I ask that you please take a moment to view our disclaimer. I'm going to show you performance results and how to protect your trades with this aggressive method by placing your stops. But remember, we can in no way guarantee that any of the results I'm about to show you will be repeated in the future. So please take a moment to view our disclaimer, and then we shall begin part 2 of this aggressive trading strategy. All right, once again, caution, this is a very aggressive version of strategy number 1. Even if you are an advanced trader, if you've been trading for some time, we do not recommend you simply jumping into the market thinking that you've got it all figured out. We want you to really study this video and then paper trade for a while. I myself only rarely trade this strategy, even though I watch it continuously. It's just a little bit too intense for me because of the way it's structured. But for you beginning traders, especially beginning traders, we want you just to watch this video and to paper trade only. Don't want you to jump in this. Stick more with the very conservative approach to trading strategy number 1. All right, having said that, let's cover once again what are the categories involved here with strategy number 1, aggressive version. Firstly, we're only going to be looking at small time frames. This means 5 minutes or less. And in actuality, sometimes it could be 3 minutes or less. We're not going to be looking at tick bars or range bars, but just minute bars in these particular examples. So the examples we're showing you are anywhere from 1, 2, or 3 minutes. We're not even going higher than that. We're still going to employ our buy-sell line, which is the 50-period simple moving average, and the same rules apply. Now when we go to our indicator, the dodging channels, we're going to go down a couple of notches. The only settings we will be using for this aggressive version are the 7-period dodging channel and the 14-period dodging channel. Okay? The reason why we're doing that is because we're looking to capture these real quick momentum moves, and we're not, sticking around for any kind of a conservative approach to entering with our pullbacks. Now we have non-confirmation entries. We talked about this last time about how you can enter. We'll talk about it and touch on it just a little bit more today on how you can enter without using confirmation. I've explained this in the past that we use confirmation for about 99% of our methodologies here, but this is one of the instances where you will not have to rely on confirmation. As well, there are no preset stops. This is the type of thing where you go and enter into the trade basically without knowing where your risk is, because we do not have a predefined stop. I'll show you where to enter your stop today, and we'll show you our specific technique for that. As well, we have no predefined exits. There are no preset exits, so you do not even know where you're getting out on the trade. Remember, these are strategies, as you can see here. There's a lot of discretion involved in this, so there's no way you can really back test it and research it. I'll show you how you can implement it, and that's why I really don't trade it a lot myself, but we have a number of advanced traders who like to trade more intensely and more aggressively the E-mini, so that's why we're sharing this with you. And then lastly, we'll show you how to place a worst case scenario stop, or where to get out if the thing just goes completely against you. And that can happen from time to time. Many times I'm sure you've seen that you've entered to a trade and you bought at the very top and it just completely fell out of bed, or else you sold at the very low and then a tremendous rally started. So we're going to show you how to place a worst case scenario stop so that you're protected in case that does happen. All right, so let's just kind of recap what we went over last week very quickly in part 1. Remember, this is going to be a 3-part introduction to this aggressive version of trading. This is part 2, but in part 1 we covered the time frame and the 50-period simple moving average. And what we want to stress once again is we're using small time frames as we have here in this 3-minute chart. Anywhere from 5 minutes and below, most likely you're going to be looking at a lot of setups that are 3 minutes and below. Okay, but we're still employing the buy-sell line the same way. If price is below, we're only looking for short setups. If price is above, we're only looking for buy setups. All right, now the dodging channels. Instead of using our standard 21-period setting, we're only going to be using the 7-period setting or the 14-period setting. Now it's pretty much up to you. This is where we ask you to paper trade this strategy for a while and really get a feel for what settings and what time frame you feel best with, and what exits we're going to be sharing with you as well, exit techniques. This is very discretionary, so there's no cut and dry rules here about you have to enter this specific way, you have to use this specific dodging channel. That's why we're laying all the groundwork here for you, but ultimately it's up to you to decide. Now, Here's our standard 21 period Donchian channel on a 3-minute chart. Now the way we normally use it is we're waiting for price to rise if we're going short, as in this example, and we want to see bars that are completely above the midline, that red midline right here. The only trouble is with these fast markets that we see in these smaller time frames, we never get above this midline, as you can see, so we never had an opportunity to go short here using the 21 period setting. So what we've done is we've sped up things, we've gone down to a 14 period, and now you see that we're beginning to touch the midline, and then we can also go down to a 7 period. Now you see that there are some actual bars above and touching and closing above the midline. So we're giving ourselves more opportunities by going down in these fast short-term markets here. All right, now we talked about last week about non-confirmation entry. Usually what we do with all of our methodologies here is that we wait for a setup bar. Once we found that setup bar, if we're going long, we're only going to enter if we trade 1 tick above. And if we're going short, we're only going to enter short if we trade 1 tick below. Well, that's all thrown out the window in this aggressive version. We're waiting for specific places to enter, but we really don't have any type of set pattern. So what I explained last week, if we're looking at this 1-minute chart with a 14-period Donchian channel, since we have an uptrend, we're above the buy-sell line. One way to enter is you can always wait for price to touch the midline. And the minute it touches the midline, you can simply enter at the market by entering a market order to buy and go long. Or if you're quick enough, you can simply see where the midline is on your chart and place a limit order there and hope that you get filled. Many times it'll trade 1 tick below or trade on that midline and you'll get filled. So as you can see, once we're above and then we come down and touch the midline, you could enter there. But let's say you wanted to use a methodology that would actually get you in at sometimes a better price than simply buying at the midline, as we see here. What you could do is go down to a 7 period, same chart, same settings, except for the Donchian channel is now reduced to a 7 period. And instead of buying right when we touch the midline, what you're looking for is a price bar to close below that midline. So on that price bar close below the midline, you can enter at the market and buy usually 1 tick above, or you can place a limit right where that is and you would have purchased it. And then as you can see, we go higher. Sometimes it'll close right on the midline and touch here again. But other examples you'll see will close below and you can buy at the market and the price rallies again. Here we close below. We didn't actually rally right after that, but then eventually we did. So those are two ways you can enter. You can either enter once we touch the midline, or you can enter once price closes below the midline. As long as all the rules are still in place, as long as the Donchian channels are still headed upwards and you're above the buy-sell line, you can go long. Just reverse the rules for going short. Okay? So we covered this last week. Remember, experiment with this. Please do not just jump in and think that, boy, you found the Holy Grail and this is all you have to do. All right, here's a 14 period now looking to go short. We're looking at a 14 period Donchian channel and a 3-minute chart, which we covered last week. As you can see, you can use this to go short every time we touched, or if you wanted to use the other entry, you could every time we closed above, you could simply enter at the market. Touch, touch. Now once we go down to a 7 period, you have a lot more opportunities to enter and a lot more opportunities to enter on a close above. Okay? And take advantage of these quick moving markets. Remember, we're not discussing where to get out yet. We're just discussing your entry. And now we're going to talk about using stops, because as of right now, we haven't even considered stops. There are no preset stops. This is very discretionary, so we're not coming in knowing where we're going to get out, and we're not coming in knowing where we're going to get out if we're wrong either. So here's one technique that we use that is very common, but is just about the most basic technique you can use for this aggressive style. And we're really looking at the pivot lows, but we're looking at the first pivot low that was generated after we got in. We're not looking at the pivot low that is already there. In other words, here's our first entry, coming back to the left here on this 14 period Donchian channel setting on a 1-minute bar. Let's say we entered somewhere around here, okay? Now up until then we have no pivot low, so we have to wait for a pivot low to be generated. Now we have a low here, and then we start to rally. So we have a low, a lower low, and then a higher low. So once we have concluded this bar, we can place our stop just below this level right here. So this is our stop. And so we can simply watch it if we decide to, or get out early, but that's where our stop would be. Now the price comes back and settles down again and touches, let's say we went long. Okay, we went long here. Well, we haven't created a pivot low yet, but on this first bar where we went higher, now we've created one because we have a low, a lower low, and then a higher low. So now this is our stop. So at the conclusion of this bar, we would place our stop roughly 1 tick or 2 ticks below. It's up to you, 1 to 2 ticks below. Our next entry level would be here. We go up and then come down and touch the midline. Let's say we entered somewhere around these levels. On the next bar up, we now created a pivot. So we place our stop right here once we have this bar concluded, and then we go higher. And then lastly, here's another example of how you can place your stops. Once again, we touch the midline, so you would have entered somewhere around these levels, but we have no pivot low generated until the close of this bar because we have a low, a lower low, and then a higher low. So once we've concluded this bar, we can place our pivot right here. Okay? Now, I would suggest placing your pivot only 1 tick below. Why? Because I usually suggest when we're trading the E-mini to give yourself a little bit room. But because we're looking at these fast-moving markets and we're not really going to stick around a long time, I would say, if we're wrong, we're wrong. If we're stopped out, we're stopped out. So I would just place it 1 tick below these lows right here. And the same concept would work going short. Now here's a 3-minute bar using a 7-period Dodging channel. We rally, we touch the midline. So let's say you would have got short here. We can't place a stop until we make a lower high. So now we have a pivot high here. So we place our stop 1 tick above. Let's say we cover somewhere around here. We go up higher and we get short again right here. Well, we got short, but we have no pivot yet. Remember, we have to place our stop once a pivot is formed after we're in. Not the pivot that was there prior to entry, but pivot that is formed after we've entered. And so we see that we enter, we make a higher high than a lower high, so now this is our pivot. We place our stop just above here, and then so on. We continue to do the same process as long as there are pivots made. And here's a kind of a different scenario. If you wanted to take this, you could have shorted right here, and then look what happens. We continue to go lower and lower, and there's not a pivot made until we have actually another chance for entry. So even though you would have entered here, your stop would have been much lower. All right, so let's look at a few of these examples this past week. This was Tuesday now, the 28th, and we're looking at a 14-period Dodging channel setting on a 3-minute time frame. All right, now we're above the buy-sell line. We have all the Dodging channels pretty much headed stair-step upward direction, but we're looking for settings while they're in the same sync, while they're all stair-step upward direction, even though you can't see the last uptick from the higher bar here, or higher channel. All of them were headed upwards when we entered long here. Okay, you could have entered long once we touched this line, or entered long once we closed below. Either way, you would have entered somewhere around these levels. And then once we formed this little, up movement, we would have placed our stop right here. And as you can see, nothing really happened, but eventually we took off, and we would have placed our stop. And then you can just kind of track it all the way up by tracking these pivots if you want to stay in a long time. Now you have another chance for entry right here, or here you would have entered once we close below, but we have no pivot established until this bar here because we've established a low, 2 lower lows, and then a higher low, so this is where your stop is. And then we went higher. Another chance for entry right here. There's no pivot established until we conclude this bar because we made a lower low close, and so we place our bar here. Now we're assuming that we're not holding on to the same position right here. We're getting out very quickly. Usually these fast trades are held no longer than 3 to 5 bars, regardless of what time frame you're looking at. So we're not really carrying the position and then buying another one and holding and buying another one. We are out of our position on the next entry. So we're out somewhere of these levels. We come down lower. As you can see, we have another entry. When we conclude this bar, we place our stop right here. We have another entry right here when we touched either the midline or we close below. On the conclusion of this bar, we have now formulated a pivot low, so we enter our stop here. And then lastly, we have another entry right here if we entered on the midline entry. And then we have a pivot once this bar is concluded, so we place our stop here. So you see, we are not placing our stop until we've made a new pivot low if we're going long. So we do not have any idea where our stop is going to be. All right, now let's look at the next day, Wednesday the 29th. Now in this case, we're looking at a 1 minute bar on a 14-period channel once again. And this time we're looking to go short. Now had we used our basic technique of shorting once we touch the midline, we would have shorted at these levels somewhere around here. And then once we made a lower high, we could have placed our stop and then seen the E-mini head lower. Then we bounce back up. Could have gotten short somewhere around these levels or shorted up here on the close, the first close above. Once we formed a pivot at the close of this bar, we had a high, two higher highs, then a lower high. That's where we place our stop. We come up here again. We could have sold right here, but let's take this one. We sold on the close. And as you can see, once we sold, look what happened. It went higher again and then even higher. So there's, sometimes you're going to be sitting through a little drawdown at the beginning. And then ultimately, we went lower to form a pivot high, so we placed our stop here. Now we could have covered, let's say, and then we would have gotten short again, so we would have placed our stop here, and so on. Now, just to show you that we're not cherry picking and showing you and making you believe that this works 100% of the time, here's another example where you could have gotten short. Let's say you were selling on a close above the midline. Well, here's a close above the midline right here. So you would have sold. You have no pivot established yet, no pivot high. Here's the next bar, a higher high. Here's the next bar, an even higher high. And then ultimately, it goes lower. Okay? So this is our pivot high right up here. We're about a 1.5, risking a 1.5 on this trade. Now, we never went lower than where we first entered. And look what happened. We eventually got stopped out. So this will happen from time to time. Now, next week, we will cover a worst case scenario type of stop, because this was okay. Even though we had formed a pivot, we got stopped out with a 1.5 loss. But many times you'll see where you'll enter short into a trade, and then some news will come out or something will happen, and it will go straight up without any chance to make a pivot. So how can we protect ourselves? Well, we're going to discuss that next week. But let's just recap what we discussed. Here are all the categories once again. In this particular Part 2 presentation, we went over non-confirmation entries, no set stop, and no set exit levels. Now, or I should say no set stop. Next week we will cover the no set exit, and we will also talk about the worst case scenario stop. So look for these two things, these two categories, to be answered in our next presentation. Now, these are points to remember. I cannot stress this enough. These are for advanced traders only. I've been trading for 34 years. I've been day trading actually for 34 years. And I don't trade this strategy all the time. So I will only trade it when I see an extremely fast market and there are a lot of opportunities. But most of the time, I would say 3/4 of the time, I'm really trading more conservatively. Remember, if you're going to use this time frame, or I should say this aggressive strategy, use small time frames, anywhere from 5-minute bars to 1 minute bar, okay? I would say tick bars are a little bit too intense. I know a lot of you students are going to ask me, can I use a tick bar or a range bar? I've never seen that this works that well on range bars, so I really would just use this on minute bars only. The buy-sell line still applies, same rules, same setting, no changes there, but the changes in the Donchian channels. We're going down to a 7 and a 14-period setting only. Experiment with which one works best for you. I know a lot of you may say, well, Steve, which one do I use, which time frame, which setting? That's up to you. That's why this is a really discretionary strategy. Okay, in closing, recap. Remember, this is extremely aggressive, especially you beginning traders out there. Do not try to trade this. Just paper trade this. If you have any questions, email me, okay? We want you to learn these strategies like the back of your hand, and the only way to do that is to watch these videos, but also to paper trade. And I would suggest trading this if you're going to really trade for at least 2 weeks, okay? Our edge here is consistency, and there's a tremendous amount of consistency in this particular strategy, but you need to learn it first. Remember, if you have any questions, please do not hesitate to email me at stephenprimo@specialisttrading.com. In closing, I ask you to take one last look at our disclaimer. I showed you some performance results using this aggressive strategy for strategy number 1, but remember, we can in no way guarantee that any of these results will be repeated in the future. In closing, remember to email me. Remember, if you're beginners or even advanced traders, to paper trade this strategy first. Beginners, I would suggest just sit back and watch for a while. If not, have a great, enjoyable holiday weekend, and we'll see you here next week. Bye-bye.